Okay, so we're gonna go look at the pairs that are currently on our watch list for the first week of June. I'd like to look at USD NOK, US dollar versus Norwegian krone, and we see that on the daily time frame it has been making these lower highs and lower lows. Price is sort of consolidated in this area around the second week of April and sort of just ranged within this overall price level. And so, first of all, to discuss the fundamentals, we know that the current regime that the US is in a stagflationary regime, a stagflationary pause, versus the Norwegian krone, which is now in a stagflationary tightening. So now Norwegian krone has a bit more aggressive monetary policy than this sort of dovish US dollar. In terms of the interest rates, the Fed has a current interest rate of 3.75%, while Norges Bank has 4.25%, and we see a 50 to 75 basis point nominal advantage favoring the NOK, Norwegian krone, with that carry flow, which makes the Norwegian krone relatively bullish compared to the dollar. And so we're looking for more shorts here for USD NOK. But again, we'll have to be careful based on the risk sentiment. We would have to keep an eye on some of the news that's coming out, especially when it comes to the US-Iran ceasefire. More peace talks or progressive peace talks would support this narrative as well as oil. When oil is going to be one of the primary influencers of this pair as well. And so we look at the technicals and we go to the 4-hour time frame, and we see that price has sort of respected this descending channel here on the 4-hour time frame, making these lower highs and lower lows within that channel. And we see that with the swing high that occurred on April 30 until that swing low, which happened May 12th, we see that prices now come back up into premium pricing and then now snagged some liquidity in that premium pricing with that double break, creating a 4-hour supply, a new and valid area of supply in the 4-hour time frame situated over here. And so we waited again and we see that price came back up. We draw Fibonacci retracement from that swing high to that swing low situated below. And we see that there was also liquidity that was left behind on that move down, reacting from liquidity. And so we see that price came back up and snagged that liquidity, changing character, creating a new and valid area of supply situated over here. This is a new and valid area of supply. And this would be our basis for our potential short for this week. And the technical setup would be to wait for this to come back up and target a risk to reward that's good enough. I would not like to go out of this overall bearish channel range because it is currently respecting that and has been respecting that for months. So I don't think it will break that even now. Keep my stop loss above that and then target sort of the liquidity that was left behind in that impulse leg. Moving on, we go to GBP AUD. And again, I'd like to focus on the weakness of the pound. We go to the daily time frame. We see the price was moving relatively bearish, making these lower highs and lower lows. And so we see the GIP regime, the UK, is in severe stagflation versus Australia, which is in a overheating / tightening phase. And that means that Australia would have more policies that would increase its strength, while the British pound, the pound sterling, would now have a bit more bearish price action relative to the Australian dollar. In terms of interest rates, the Bank of England has a 3.75%. It's a dovish interest rate versus the RBA, which has a 4.35%, which is increasingly hiking. And so we see a negative 60 basis point nominal disadvantage for GBP. We would have to wait until some more peace talks would occur. That would also be a risk premium for the Australian dollar. that would totally affect this trade and would actually support it if more peace talks were to emerge this coming week. But we will have to see and wait patiently for that. And so we'll be looking for shorts for GBP AUD. And if we go to the 4-hour time frame, we see that price creates a new invalid area of supply here around the end of April. And from that swing high to that swing low, we see that price came back up and actually liquidated the areas of liquidity that was situated in premium pricing. And that in itself created this bearish reaction from that, making lower highs and lower lows from that, very rangy. However, the current data fundamentally supports this short. And so we drew our 4-hour supply. We see that came back up after breaking, sort of breaking these lows over here. We see the price came back up and liquidated some areas of liquidity situated over here, reacting to that, breaking structure, creating a new invalid area of supply in the 4-hour time frame. And so when it created that valid area of supply, we see some liquidity on that impulse leg down, and we're looking for it to come back up into those areas of liquidity and sort of snag those areas of liquidity, change character, come down for our position, targeting these ascending lows here, which contain liquidity. And so that would be in line as well with the fundamentals. Moving on, we have Australian dollar versus Canadian dollar. This is very connected still to the reason why we were considering GA for shorts. AUD CAD is now in potential longs. We'll see that because we have different regimes. We have Australia, which I said earlier is in an overheating / tightening regime right now. So it's very bullish. They want to raise the interest rates. They're very aggressive in fighting that inflation. Versus Canada, which is now in sort of stagnation or a disinflation regime right now. And so if we compare the interest rates, we have RBA having that 4.35% hawkish interest rate versus the Bank of Canada with that 2.25%, which is regarded as sort of dovish / paused. And we see there is a nominal yield spread, 210 basis point advantage for the Australian dollar against the Canadian dollar. And the risk on atmosphere that's being presented right now by the geopolitical tensions is good for AUD CAD longs. And so we just keep that coming, and we see more peace talks would actually support this, and that would be a good short in my opinion. In the 4-hour time frame, we see it's been making these higher highs and higher lows within that overall bullish channel it's been making. And so this bullish channel has been respected and started around the second week of April. And so we don't expect that to break anytime soon. But we will be waiting for some pullbacks into the most recent area of demand situated over here. And some liquidity was left behind by that area of demand over here. And so we're waiting for that to snag that liquidity, change character, and probably target those longs and put that stop loss below that most recent 4-hour demand, and not go beyond sort of the next fractal high in the grand scheme of things, in order for us to prevent any negative or rejections coming from this overall bearish bullish channel. Next, we're also looking at NZD CAD, but only temporarily, and it's a bit fragile in my opinion. First of all, because the interest rates of the RBNZ and the BOC are exactly the same, with 2.25% for both, which gives a 0 basis point differential. And that sort of tells us that the only factor that is influencing this pair at this current time is the risk sentiment, as well as the effect of commodities. And so we'll have to see how oil would react this week. As long as oil becomes weak, continues to be weak, this would support this current setup right here with this bullish order flow. If oil starts picking up some momentum on the upside, then this would not hold, in my opinion. And so we're looking for those shorts here for NZD CAD, making that area of demand already, and creating those areas of liquidity within that impulse leg, and waiting for some internal grabs of those liquidity points, reaction, and then break of structure, creating a new valid area of demand, and probably target that 1:2 risk to reward along the way, as long as the fundamentals do align. NZD CHF, same thing. I'm looking at the strength of the New Zealand dollar, the Kiwi, and this actually might be better, even a better option than NZD CAD, because the Swiss franc is now for the whole year at a 0% interest rate policy, and so we see a yield differential advantage for the New Zealand dollar. This would be a very good long position in my opinion. It's already made this area of demand. It's traded over area of demand over here, and that in itself is going to be our basis for potential longs, with the liquidity that it's left behind on that impulse leg up. So I'll be waiting for that liquidity to be taken out, and then have a positive reaction to that, to the upside, targeting a positive risk to reward from that, and that would be in my opinion a better option than NZD CAD. And then finally, we're also looking at USD JPY, UJ, because now it is currently approaching that buy up before that big sell down, which was the intervention, which the Bank of Japan did around April 30. And we have some reports from Goldman Sachs and other Wall Street private equity that the Bank of Japan currently has the capabilities to have 30 more interventions within the coming months and years. And so any price action that's moving within this point is for me potential short positions, as this is the intervention level, as you can see, and that was the intervention supply, because that was the last buy up before that intervention. And so I have currently set a limit. I'm trying to see what the best risk to reward would be for this at currently, but right now something like this would suffice, and maybe target that 1:3 risk to reward for USD JPY.